In this video, we're going to be performing a deep dive on Realty Income's dividend safety. To begin, let's talk about Realty Income's business model. Realty Income is a real estate investment trust, or REIT. The trust owns more than 4,000 standalone properties that are triple net leased to tenants. That means that the tenants are responsible for paying rent, property taxes, building insurance, and maintenance for the properties. Realty Income counts Walgreens, Food Alliance, FedEx, and Walmart among its largest tenants. Realty Income has a current market capitalization of $21.5 billion and generates $1.3 billion in annual revenues. Realty Income is a well-known dividend stock because of its compelling track record of dividend growth. With 27 years of consecutive dividend increases, Realty Income is a member of the Dividend Champions Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Realty Income has a few advantages over other companies. First, as a REIT, the trust is required by law to pay out at least 90% of income as dividends. Additionally, Realty Income is one of just 41 companies that pays a monthly dividend, which allows shareholders to compound dividends at a faster rate. Looking ahead, investors interested in owning shares of Realty Income will likely want to know the safety of future dividend payments. For the remainder of this video, we will discuss the trust's current dividend safety from 4 perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Realty Income's dividend safety in the context of the trust's current adjusted funds from operation per share. When Realty Income announced its fourth quarter financial results on February 20th, the trust reported that it generated adjusted funds from operation per share of $3.19 in 2018. For context, Realty Income paid $2.64 of common share dividends during the same time period for a dividend payout ratio of 83%. REITs with very high payout ratios are not uncommon because they are required to pay out at least 90% of income as dividends. After accounting for this, Realty Income's dividend appears safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Realty Income's current dividend payment to its free cash flow. In 2018, Realty Income generated $941 million of cash from operating activities and spent $14 million on capital expenditures for free cash flow of $927 million. The trust distributed $762 million of capital share dividends during the same time period for a free cash flow dividend payout ratio of 82%. Using free cash flow, our conclusion is the same as when we used adjusted funds from operation to measure Realty Income's dividend safety. The trust's dividend appears safe for the foreseeable future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Realty Income's current dividend safety in the context of the company's historical recession performance. We believe that the best way to ensure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Realty Income's performance during this time period is shown here. Realty Income experienced just a 3% decline in adjusted funds from operations per share from 2007 to 2008, before rebounding to growth in 2009. Not many companies or REITs had similar results during this time. More importantly, the Trust's adjusted funds from operations per share continued to cover its dividend, and Realty Income continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the Realty Income's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Realty Income's current dividend safety is by looking at the Trust's current debt level. More specifically, we will see how much the Trust's weighted average interest rate will need to increase before the Trust's free cash flow will no longer cover its dividend payment. In 2018, Realty Income generated $266 million of interest expense and had $6.5 billion of debt outstanding for a weighted average interest rate of 4.1%. The following image shows how changes to Realty Income's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Realty Income's weighted average interest rate would have to rise above the 7.5% level before its dividend would no longer be covered by free cash flow. While we generally prefer companies to have a larger margin of safety for this metric, we believe that Realty Income's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Realty Income's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.